Welcome back to the Kelowna Real Estate Podcast. I'm your mortgage broker host, Taylor Atkinson.
And I am your real estate agent host, Matt Glenn. What's going on, Taylor?
Having a pretty good, good Friday, actually. So we're recording this intro, but Easter weekend is here. So everyone gets a bit of a break.
Yeah. Great Friday. My son was born last year on Good Friday, so I renamed it to Great Friday.
Nice.
Yeah. The last year was April 7th, so got a couple of weeks still, or 10 days or so.
Yeah. No, I'm looking forward to that birthday party. Should be good.
Yeah. We've had 2 one-year-old birthday parties in a row. When you have a 1-year-old, you'll have lots of friends that are also 1-year-olds. So you go to a lot of baby parties. And it's awesome.
At least they're short. It's like a 2-hour window because everyone has a nap schedule. So it's like,
they're short. There's drinks, there's cake, and you get out of there.
Yeah.
It's actually awesome.
Okay. Well, what's going on? I mean, it seems like every day there's legislation changes and new bills coming out. So what's happening, newsman?
Yeah. So the Renters Bill of Rights proposed. So this will allow the renters to use their rental payments that they make as their credit score when they're looking for a mortgage to eventually get into the housing market. Landlords will have to disclose what the units were previously rented for.
And a standard lease agreement nationwide.
Yeah, standard lease agreement. But BC has a pretty strong lease. So I think if anything, it's going to stay the same, if not get a little weaker. Can't imagine it gets any weaker. So it's probably going to stay very similar.
I mean,
I'm okay, I think, with the standard lease agreement across the country.
I think the standard lease agreement's fine as long as it's decent and protects both parties instead of, in BC where it just really protects the tenant.
Yeah.
I mean, if I was in Alberta, I'd probably be pretty upset because the lease agreement.
Well, that's what I'm saying. Are they going to make the BC one stronger? There's absolutely no way that Alberta's going to love that.
Well, I mean, is it also just a standard lease agreement, but they don't cap rent control? Or are they talking about the same rent control across Canada as well?
Yeah, I guess we have the Residential Tenancy Act in BC. So it would just be the lease agreement. Not the whole act, obviously, across the country.
Yeah. But I mean, the lease agreement for BC, we get from the tenancy branch anyways. But
yeah, we do.
I'm not opposed to the standard lease. I'm not opposed to the credit score. I think that's actually a decent idea. They've been talking about that a long time.
My first thought when I heard the credit score thing was man, this is more leverage for the landlord. Listen, don't ruin my place or I'm going to give you a terrible credit score. But then you were saying that it's automatic reporting from your digital payments or from your electronic payments.
I think that's how it's supposed to be. But I mean, policing any of this is going to be so time consuming.
Even me just thinking about this is crazy.
Yeah.
How much money is it going to cost just to push paper to get this going?
Yeah. And then disclosing rent for the previous history really doesn't achieve anything. It doesn't help anyone negotiate. I mean, none of this really makes a ton of sense. Again, it kind of, to me, it's they're grasping at low-hanging fruit media straw just to act like they're doing something. But the resources that they'd be spending on this is just insane. I would love to see the budget, the man hours allocated to it, because I feel they could probably build 100 houses instead.
Way more than 100, 100 houses a day.
Yeah. It just, I don't know. It's chaos. We had an episode, about a month and a half ago. Nicole Watson came on, CPA, accountant. We spoke about.
Yeah, I saw this. I was thinking about her.
Yeah, the Bare Trust Agreement, which put accountants under a ton of stress over the last couple months.
Just put everyone under a ton of stress. Listen, I was calling clients, you co-signed on this one. You should call your accountant.
Yeah, and everyone was working on this until a few days ago.
Yeah,
and now they've just decided to change it again.
Well, because they realized it was insane. I don't even know how many thousands of houses would not have reported that they co-signed or that they had a 1% name on a title. They had no idea, never thought about it. And now they got these tax bills.
There was also a slight revision on the short-term rental legislation. And they kind of broke down, if you were operating before December 2023 and the building has a front desk and a couple other little requirements, then it potentially could continue to operate in the future. I think that's great. That's positive, but stop changing your mind. I can't keep up.
Is that supposed to come in May 1st, that whole thing? So
it is.
I guess they can change their mind now.
Yeah. I appreciate that step, but I think they're opening up a can of worms. They're giving themselves, more thread to pull on.
And then what was that thing beside the Ramada? They're going to build that little for short-term renting. Oh,
yeah.
What?
Yeah. Same with the Mark Anthony group, which is great. A 12-story kind of boutique hotel.
Well, something, honestly, we've talked about this before. Something needs to happen with that site.
For sure.
My God.
I think originally it was a 4 to 6 story kind of wine tasting venue, a great little spot.
Yeah.
And I would probably do the same thing if I was the developer and I knew that short term. But why are we taking those units off and then building? It's It's tough, man. I'm exhausted.
Yeah.
But to focus on some more positive news this week, Century 21, who sponsors this show and every show moving forward, threw on a great award ceremony at Mount Boucherie Winery.
My God, they throw a party.
Yeah.
It is awesome. Yeah. Where were we? Mount Boucherie at the Modest Butcher.
Yeah.
I guess the Modest Butcher was upstairs, but we had a fantastic party. Wine was flowing all night. We gave out our awards. And I've played hockey my whole life. I have a lot of trophies. I have never got trophies like these trophies, man. These are quality trophies. They have some girth. They have some weight to them for the Centurion Award. So that was really a fun night. Everyone, I think, had a great time there.
Yeah.
Judging by social media after, everyone had a great time.
Congratulations to you and my wife, Emily. You guys both did a fantastic job last year and got some acknowledgement for it. Yeah. Now you're making me kind of think, though, I played sports my whole life, too. And I think I got some T-shirts to show for it. So.
Yeah. Yeah, honestly, Emily and I are at the best brokerage. There's no doubt about it. That night, I actually sat back with my wife. We got our spots right by the bar, so it was perfect. The food just kept on coming to us, and also everyone had to get drinks, so we just got to talk to absolutely everybody in the place over and over again. And I just was thinking, we have something good going on at this brokerage, and I love it. If you're looking for a change or you want some more help, give Max a call or give me a call. I can't say enough about it. I just love it. Yeah.
Or if you just want a good party and wine and a heavy award.
Heaviest award. Yeah.
So going into our show, today, I guess, we brought on Will Pigott. He's a friend of mine I was introduced to. Commercial mortgage financing broker. He used to work for one of the very large banks, did a lot of creative deals. He's recently changing over to commercial real estate agent. Yeah. So we're kind of in this transition period, but had some great insight on some regulation changes that came in from the lender perspective and why they've kind of tightened their asset portfolio a little bit. Yeah. But
he mentioned things that were not everyone in the public would know it, but it has major implications for the housing market. And it's one of those things that happens, you would never know until you talk to a guy like Will. Yeah. It was an interesting episode. Obviously, it was definitely in your guys' lane as the lending more, but I loved it.
Yeah.
It was fun.
And I think it goes hand in hand in what we've said before on the show is as the end consumer, you're never going to know all of this information. Even as a mortgage broker, I'm not going to know all the rules of a real estate agent and vice versa. So you just really got to work with people you trust and rely on them to have your best interest. And so, it was really fun to chat to Will about that kind of stuff.
Amen. Honestly, it was I just did not know. It was I was getting smacked in the side of the face with information. You kind of think as an agent, I know what's going on with mortgage broking. Obviously you kind of know the basics, but then you have a conversation like this and it's just my God, this is why you have professionals. So
yeah, no. And just in general, he's an awesome guy. He's out ski touring and living his best life. So if you want to talk to him about some commercial financing stuff and or commercial purchases or selling or whatever, reach out to him. He's a good guy to chat to and have on your contact list. So enjoy the show, guys. Happy Easter. Yeah. And congratulations again, Matt, for your award.
Thank you, my friend. Enjoy the show.
Hey, Will, thanks for coming on the show, man.
Yeah, welcome to the show.
Thanks for having me, gents. This is awesome.
Yeah, so how we like to start our show is just kind of what does your perfect Friday look like? This is a Kelowna real estate orientated show, so a bit of business and then leading into the weekend, having some fun.
Yeah, totally. So I usually start my day at 6:30, try and get to the gym. I find a little exercise, really starting the day with purpose, really makes a big impact on my focus for the day. Usually try and skip breakfast. I'm kind of a half-hearted intermittent faster. I don't let it control my life, but if I can make it till noon with a cup of coffee without eating, it helps me. I don't find the energy impact is too significant. So my role is kind of a mix of business development and credit underwriting. So if I can mix in both within a day, I'm usually feeling pretty good. So maybe the morning's hammering out some client meetings or some cold calls, in the afternoon underwriting, doing a little bit of analysis. And then in the summertime, if I'm on the golf course at 3:30 with a client, that's usually a nice way to mix in some business with pleasure. I haven't quite figured that out for the winter months. Got to find some prospects that love skiing as much as I do. But
get to sim.
Yeah, that's the 2025. That's on my hit list.
Yeah. Well, I'm a client that loves to ski.
Hey, man, we got to make that happen.
I see your Instagram stories. You're out there shredding powder all the time. And, here I am behind a microphone, just
please.
I love the business golf idea. Honestly, I'm trying to embrace that this year.
Oh, it's the best way to get to know someone kind of at a deeper level. You know, conversation evolves so much in 4 hours, and you can really see how somebody operates on the golf course, whether they're a putter thrower or just like calm, cool, collected ace. Who knows?
I was doing a presentation at my office last year, like probably around this time, probably in the spring. I was like, my goal, I want to go golfing like once a week with clients or random people and just meet people on the golf course and know them. And I was like, and I have a baby due in a couple of weeks. Just immediate laughter. And I was like, what's so funny? What's so funny about this? And it turns out the whole year I went golfing like 2 times. And they were both work events. So like didn't get out once. So but this year is my year.
Let's make it happen.
Yeah.
Yeah, life gets less busy as your kids get older, for sure.
No, I know this.
Okay, well, back to business, because some of us work around here, not like you two. So you work for a major Canadian institute for lending on the commercial side of things. What have you kind of seen in the landscape over the past year to 2 years? Like, obviously, you know, Bank of Canada has come out and, you know, Matt and I are more focused on the residential side of things, but the commercial point is very important because a lot of these projects are being, you know, facilitated from commercial lenders or even small business owners, like supporting the economy. So what's been your guys' position? How's your portfolio look? Are you guys deploying money in these projects?
Yeah, so it's been, I'd say, a little bit slower in the last couple months for sure. But, you know, in part, the rising interest rates have a lot of people on the sidelines. So maybe you're seeing certain opportunities that are slightly more marginal, or it's just harder to debt service at the higher borrowing costs. So that's definitely been a little bit of a pullback on transactions taking place because people are kind of waiting to see, you know, when are interest rates going to fall and then maybe make a move then. But it's been a pretty dynamic year, I'd say, or 12 to 18 months in the commercial banking side of things. There have been some pretty significant regulatory changes that have shifted how the banks think about doing business. So Basel is essentially like an international set of rules that all the banks have to adhere to. And beyond that, you've got OSFI, who is the Canadian banking regulator, so they can make some rules in and above that. But on the heels of the financial crisis, you'll see these enhancements to the Basel rules. So in 2023, there was a new set of rules that came out, and the biggest impact that we felt from that is really the capital allocation that the banks have to have. So there was a 2% increase in the common equity or capital equity component that the bank has to hold for every risk-weighted asset that they have. So 2% increase on the trillions that the bank have out in loans is a pretty significant change. So essentially, within the course of a year, is billions of dollars that the banks have to hold more in equity for all the money that they've already lent out. So with that, we've really seen a big shift in capital allocation being a focus for the bank. So you've always got the credit component whenever you're looking to lend out money. Now there's the business element. Where are we deploying the capital? Does this make sense for the bank from a financial perspective?
This is super interesting. This is something that most people wouldn't know of a rule that changed.
Yeah, it was kind of behind the scenes, and even somebody working in the banking space, it's kind of been fluid in how this comes out. So where we've seen the biggest impact of that is return on equity is a very important metric that the banks look at. Whenever we're looking to do a loan, that's basically what we look at. How much equity are we setting aside? What's our return on that amount of money? So when you're having to hold, let's say 2% more money than you were before, your return on equity has already been impacted. So we felt that in our internal cost of funds across all the banks, you're basically seeing more of an internal cost of funds for any dollar that you're lending out. So not only the Bank of Canada hiking interest rates, are you going to feel that obviously immediately, but this is something else that has been kind of trickling out over the last year or so, and it's something that people are still getting grasp of, but it's had a pretty significant impact in what we've seen over the last 12 to 18 months.
So it's like if that regulation comes out, just thinking about this, they can't just get to 2% right away. It probably takes a while.
Yeah, so there's an implementation period in which that would like be required, but you know, as Canadian banking system's pretty sound. So, you know, they bring out this rule. Everybody's already on side of it, but you want to make sure that you've got like quite a bit of wiggle room. So it's not like it was a material impact right out of the gate from, oh no, we're not going to meet these requirements. Everybody was pretty much there, some more so than others, but you're not going to be tiptoeing like the minimum requirement. You're going to want quite a bit of wiggle room. So really a lot more attention being paid to these risk-weighted assets and where the capital is being deployed.
Interesting.
Would a way to recoup some of that or build that buffer in, like just that time of renewal, say somebody has a mortgage product coming up for renewal, you as the lender would just say our renewal rate is, X amount and it's quite a bit higher than some of the other lenders. And then somebody's going to switch their mortgage to a different lender and then you recoup that capital back or like.
Yeah, that could be a scenario, where you're basically saying, hey, we need our return on equity to be X. And this is where we feel comfortable renewing a facility. And if you're not there, like if you got to take that business elsewhere, that's just the way it goes. So
yeah, because we have seen it on the residential space. There is a lender that basically was just out of the space for the last 12 months. They've finally come back to the market with like competitive rates, which is nice to see. But you do see that every 3, 4, 5 months, different lenders will have a more aggressive rate and deploy that capital because they don't want the cash just sitting there not making money.
Absolutely.
Right. So you're really walking quite a fine line.
And so you could see certain banks that maybe have a better capital stack, more capital to deploy. Yeah. And those banks can be a little bit more aggressive on the rates that they're able to provide because they've got that money that's sitting there, maybe not generating as much as it could. So there maybe is a bit of disparity between some of the banks right now with these changes that have been coming out.
Man, I need to work on my capital stack.
What do you see in terms of like what do banks like as a portfolio, like to allocate the assets? Do they want a certain percentage in residential, commercial, industrial, construction? I guess what's the least amount of risk with the best amount of profit?
Yeah. So, I mean, asset types, like the flavor of the month can always shift, right? Like right now, office is obviously a bit of a tough space to be in. In Kelowna, you've got one developer finishes a massive project. Now you've got this insane amount of supply that can completely skew the market. So I would say office is one that's probably a bit tough, but each asset that we're evaluating is going to have its pros and cons. So really understanding what's the tenant makeup, if it's residential, where is it located? I wouldn't say that there's like de-risked based on a certain type. There's obviously so many important characteristics. But from a commercial perspective, looking at who is the landlord, what's their experience, who's managing the property, the tenant mix, when are those leases maturing, like what is the risk that someone's going to walk from their lease within the middle of our term and then we're not going to know where our loan's going to get paid back from. Like those are the key things that we look at when you're looking at the income producing properties. But I'd say the big thing for banks right now is relationship. Like we hear it so much across all the banks. Basically, we want everything that you've got. And so before maybe you would benefit from having your eggs spread around, maybe a little bit over at Bank A, a little bit at Bank B. Yeah. Now there's more value for the customers if you have all your eggs in one basket. They can put more weight on all of the products that you're taking and give you a better deal as a result of that. I think that's been a shift that we've seen in the last 12 to 18 months as we look at things holistically. That's really taking, a frontline approach in what we're looking at for new customers.
Is that commercial or residential as well? Like, what do you think?
It's residential as well. So the funny thing with that is like I have that conversation pretty frequently with clients because I go, okay, here.
Had it with me.
Yeah, I just pocketed the extra profits from you.
Yeah.
So there's certain lenders that do like a cash back promo, but to get the cash back, like when we fund the mortgage, you have to have your mortgage payment coming out of their account. So you have to set up an account with that lender. Oh. Other lenders will provide a better rate, kind of like a cash back, but it's a savings over the term. And it's the same deal. You have to sign up. You have to have an account. They're really trying to like claw people in. Like,
so who would know that when mortgage broker?
Yeah. So it says it on our rate sheets. It says, these are the stipulations of the cash back, or here's a standard rate if you do not want to bank with this bank, discounted rate if you come in and you set up an account and you have a one-on-one meeting with said lender. It's not like life-changing. We're not talking like they're going to give you a % off. Well, yeah, we can talk. Yeah.
It can be impactful though. It's really trying to get away from the single service product offering.
Yeah.
That's been kind of the flavor.
And that's the last 12 months, 12 to 18 months.
12 to 18 months, I'd say. I think I'm kind of guessing where it's coming from. And I think it's largely from these capital requirement changes that the regulators have been imposing.
Right. Because then as a client, you're going to hold other assets, investments, cash, et cetera there. And that's going to help build up their capital.
Yeah. I mean, if you're taking a piece of the bank's pie in terms of like borrowing money from them, they want to make sure that like if we're setting that aside for you, what are the other products that you may be taking on rather than, certain banks maybe were really going hard on just trying to do as many mortgages as they could. Mm-hmm. And the thought thought being maybe we'll get the extra business that comes from it. Sometimes you do, sometimes you don't. And I think now with the fact that capital allocation is getting such a focus, like if you're not going to bring us that other stuff, maybe we'll give you an offer, but it's not going to be as good for our clients that have everything with us.
Yeah. Interesting.
That is interesting. Yeah. Sorry, I don't need to dwell on this, but like, I feel like
you can't get a cheaper rate match.
This is something that you should plan for in advance, or can you just change it at the time of applying for a mortgage?
Yeah, time applying for the mortgage. So like,
okay,
there's a couple major lenders who are super competitive in the residential space.
Yeah.
Very equal type of products. And basically the requirement is for one of them, you just have to have an in-person meeting and set up an account before the date your mortgage funds.
Yep.
And the other one, you have to have an account set up and your first mortgage payment being taken from that account, like an auto withdrawal, to get the cash back incentive. Yeah, maybe the relationship building aspect, it's not like you need to bank there for 5 years, at least on the residential side. I'm sure the commercial may differ.
Yeah, I mean, if we are looking at something and we understand what would come from that, you're going to price that into your opportunity. If we're just looking at doing a mortgage, all you're looking at is the spread on whatever interest rate you're going to be providing on the mortgage. Now, if we're bringing in forward exchange, for example, or if the person has private banking or wealth management, all of those things, we really have improved a lot in terms of looking at how all those areas drive revenue for the bank. And at the end of the day, that's going to drive down your pricing on whatever product you're looking for.
I think I've had this conversation 4 times today where you think everyone knows what you know, but then you tell people and nobody knows. Like in the real estate space, we've had a legislation coming down every week. It feels like something changing, interest rates, city, what this municipality is doing. As an agent, I'm in this every day. So I feel like I know all these things and they're just kind of getting boring me telling it. But then I have client after client just has absolutely no idea what's happened in all these rules. So I think for you guys in the mortgage and lending space, something like this is mind blowing to me.
Yeah. Okay. No, thank you for pointing that out. Yeah. It's a topic of conversation like I have in my call with clients.
Yeah.
And usually I get a similar response like, well, this seems annoying. Like, why do I have to set up a bank account there? But it's purely a business funnel for lenders to go, okay, if we're going to give you money, we want to try and, well, it makes sense now that they've changed it.
Yeah. The more you bring to the table, the better offer you can drive.
Yeah. All right.
There you go.
Lesson learned.
So I feel like the narrative's kind of like, oh, these poor banks, the government's come out with these changes and now you have to stack your capital a little bit thicker and all this stuff. For me, I'm starting to feel a little empathetic. But then there's lenders are making trillions of dollars. So do they really need to have such a buffer? Like, what is the risk that the Canadian banking system is just going to collapse?
Yeah. So, I mean, the Canadian banking system is pretty sound, internationally regarded to be quite up there. So the reason they do this and have the banks hold this equity relative to whatever they've lent out is to make sure that, when loans start going sideways and if there's write-offs that have to occur, the bank needs to be able to withstand those losses and ensure that it doesn't collapse. So usually we see these additional rules come out on the heels of financial crisis. So this one might have been in part relating to the Silicon Valley Bank, but we don't want to ever push it that close. And so as the loan loss provisions go up, they really just want to make sure they're playing it pretty safe.
Yeah.
So, I mean, it's a very complicated metric. There's a whole lot that goes into those rules and regulations. I've only kind of done a high level research to try and understand what I was seeing on the banking front. Like, why are we seeing cost of capital go up internally?
Yeah.
And so, I think there's a lot of buffer within the Canadian banking system, but you don't want to risk it too much.
So is our banking system in a good spot because of these kind of regulations, or is it just because the banks are just really good people and they're holding us?
There's some pretty tight regulations out there. So there's a lot of bandwidth for the banks to absorb quite a bit of defaulting loans.
I just thought about from you, and you're like, the banks aren't hurting, but they have to do all this. But it's the reason why we're in a good position is because of these.
Oh, thank you, banks. Thank you. I'll send out my letters later. Well, it's funny how regulations still change in the banking system. It seems like such a simple kind of black and white economic system, and it's been around forever. How much more do we need to change?
But bear in mind, we haven't really seen all that much turbulence yet. Yeah. Right? We're kind of waiting for the shoe to drop. If rates don't start coming down, maybe we'll start feeling that pain. Obviously, people are already feeling that pain. I heard on the news this morning that mortgage defaults are increasing, but you would assume that that's going to happen when you've got the Bank of Canada overnight rate at 5% for as long as it has been. So I guess it's been interesting to see the interest rate forecast. Everyone's expecting these cuts to happen, but it keeps getting bumped out because I was looking at what our forecast was in January and we were like, undoubtedly it's going to happen in Q2. And now it's like, I think it's going to be Q3 now. And so maybe it's only going to be 75 basis points in 2024. They're still expecting another percent in 2025, but it's definitely like getting a little dovish on the cuts.
Yeah. I guess what's your stance? Like, I know Matt and I are pretty optimistic of the Kelowna market in general, but are you like, the world is going to end or things are going to be okay? Or
well, I think we live in a little bubble here in the Okanagan. You know, there's such population growth that's driving everything. You know, so much of what we see on the commercial banking portfolio is the support of real estate development, whether you've got subtrades and whatnot. And that's just been ticking along famously for the last little while. So we really haven't seen too many cracks in the portfolio. Hopefully that continues. I mean, in my talks with developers and the subtrades, everybody's still doing pretty well for 2024. Maybe you start to see projects curtail end of this year, 2025, maybe that's where the gap starts coming in. But everybody seems to be doing well for the time being. And population growth, really, I think has got to be the biggest driver. That Canada, obviously, GDP is growing primarily from that population growth. And then you see that even more so in this amazing place.
Yeah, I mean, we've spoken about this before. It's like, as a developer, would I want to be developing in BC right now with like provincial legislation that's been coming out? Like, there's a lot of volatility from it. But like you said, the safety net's in the population. Like,
and how amazing it is here.
Well, yeah.
And the air we breathe in this building.
And then you get to hang out with Matt.
That's right.
Yeah.
Oh, and I am a party man.
Yeah.
So that is
$1 million single family house is worth it just for that.
You said you don't think the shoe has dropped yet on the interest rate? I find that interesting.
Well, I mean, end of 2023, we're thinking that rates were coming kind of Q1 2024.
Yeah.
And now, I mean, the Bank of Canada's got their next announcement tomorrow. All indications it's a holding pattern, really looking for what kind of additional commentary they provide on that. But it's really going to be a matter of, you know, is it Q2 or is it Q3? And they're really concerned about giving too much of an indication that rates are going to start coming down, because then it's going to be that flood in the market. You know, the amount of people that are kind of sitting on the sidelines waiting to make a move on real estate is pretty staggering. So we'll see, like,
it's kind of crazy though. Like, to me, the floodgates have kind of already opened early for spring market. Like, we're recording this early March and this will be out a little bit later, but like, it's been busy. Fixed rates have just steadily been bumping down, you know, like you can get an insured mortgage for less than 5% now. People are comfortable with that. A lot more activity. So yeah, I agree. Like, as soon as we get that first rate cut and there's confidence,
it's good that the clouds have lifted, man.
Do you think they're going to give a rate cut and then the next one they're going to bump it back up again and just be like, gotcha?
Yeah, I feel like they don't want to overcorrect here, and it's so hard. I don't envy their position because, you know, you're looking like so far out.
Yeah.
The lens that they're looking through, it's just...
It is kind of nice, though, to be in a position where, like, if things started to sink, there is a lever to pull where they could just drop the rates, right? So it's kind of nice to have that. Instead of just the rates at rock bottom, then shit hits the fan. So what do you do now? You know, so like, I feel like that's a bit of a favorable position.
Yeah. Can you give us a little bit of rundown on some terminology? Like, talk a lot about cap rates in commercial. Like, if somebody wants to get approved for a commercial mortgage, say it's an investment property, multifamily or commercial office space, and they come to your office and say, hey, Will, give me some money. What are the requirements?
Yeah, great question. So I would say in the current environment that we're in, loan to value is kind of out of the question. So the amount of financing that you get relative to the value of the property, you know, it doesn't even matter anymore, because what it can cash flow is really the key component right now.
Interesting.
And so, you know, we haven't really seen values move yet. So those capitalization rates haven't really moved. But really the biggest thing we're looking for is the debt servicing ratio. So whatever your net operating income is, cash flow from the property less any operating expenses, needs to be typically at 1.25 to 1 of whatever your debt obligations are. So, you know, if you're going to a chartered bank, you're going to have some form of a buffer in there. So that's typically how we're looking at it. So having looked at a fair amount of commercial and income producing properties in the Okanagan here, you know, right now, say you're borrowing at 6% financing, for example. you're like 45% loan to value. So you're going to get 45% financing of the purchase price. Now, that I think has been in part why we've seen a bit of less action in that space. Yeah. You know, the sellers aren't really willing to give things up for a discount right now, like where you're going to deploy your capital. And the buyers are having to come up with these massive equity contributions in order to get these deals off the line. Now, you may be able to go to other lenders out there that don't care about cash flow as much, but amongst the big five, you're going to need to be able to cover those debt obligations with a buffer on top of that. And so there was so much action 2 years ago when rates were maybe 3%.
Yeah.
Now there's a lot less happening unless maybe there's ulterior motives for a property. Could be income producing for the moment. Maybe you've got aspirations to develop that. In those situations where you can see the value add down the line, maybe people are willing to make a move in those cases.
So would it have to be like an experienced developer to buy something like that to get that favorable?
Well, so if you're looking at it from a traditional commercial banking perspective, in terms of how much money can we give you for that project, I'm really only going to look at it based on what the leases support in rental revenue. Yeah. If you were looking at it from a development perspective, most likely, depending on the dollar value, you're probably going to have to talk to a credit union. But I mean, can take a little while to get those plans in place. So maybe it is you're financing with a chartered bank at the get-go. Yeah. Get those permits and whatnot. Down the line, the credit union can look at financing the development.
Not to put you on the spot here, but like, how does a bank look at something like a vendor financing on projects? It seems like a lot of the deals have some sort of creative financing component.
Yeah, I mean, I would say right now with the tricky landscape and the divide between buyers and sellers on the commercial side, like those creative aspects to a deal, it's kind of the differentiating factor to get things over the line. Yeah. It would probably need to be deal specific. I can't say in my experience doing any real estate financing, there has been a vendor note behind the bank. We don't typically love that. I mean, the issue there is whether it's interest accruing and amortizing, then you're going to have to consider how is this loan going to get paid back while the bank is still getting paid back. So if the vendor is willing to fully postpone and basically say, hey, you know, we're fully behind the bank on this, doesn't matter, then that could really probably help you getting the deal across the line. The bank would have to be comfortable with that. But if there's any element of debt repayment, I mean, the biggest issue you're facing in today's environment is how do I get this thing to debt service at the higher interest rate environment? Yeah. Because, you know, we haven't really seen rents booming like we have on the capital value appreciation. Yeah. Now, how that pans out over the next 12 to 24 months in this higher interest rate environment, maybe we start seeing some of these properties that can't quite debt service at the higher rates coming on the market. There just hasn't been a whole lot of transactions taking place from what I've seen.
Yeah, like it's pretty tough to have a vendor take back behind, like in second position, like to make up for that equity you need, fine. But then if you're debt servicing it, like unless the vendor take back's at like 1% on a 50-year AM and the payment's so small that the lender's like, oh, cool. It doesn't actually, like they can afford that in their debt service ratios, you know? Yeah. I think when you get into that larger landscape, it kind of has to play a role. The funny thing you mentioned there is like, you guys qualified mostly on that cash flow, that debt service ratio. And I find a lot of people trying to get into that space, whether it's a multifamily or office space, they're almost upset. Like, oh my God, like just give me the money, you know, like, but it's such a safety net to go through the due diligence with commercial lenders and appraisers and everyone that's doing their job. Cause like, how are you going to float a $4,000 net loss every month? You know, like people don't really look at it that way on the cash flow. They look at, you know, the upside. So I think it is like super important that banks are doing their job in that regard.
I would add on that too, from a commercial banking perspective, when we're looking at these income producing properties, it's really on the credit merit of the property itself. Like we're not considering what your personal net income is to float any gaps there. It's really, can this property on its own support the mortgage that's being requested? So that you sometimes see that bit of a difference on the small business side, perhaps, where they take into consideration the personal credit worthiness a little bit more. But in commercial, it's pretty much on the merit of the property.
I mean, you just mentioned the rent, where rents are. Do you feel commercial space right now is fairly equal for the rental income compared to residential rent? And the reason I'm asking is because obviously in BC, we have residential rent control, Tenancy Act, where Alberta, we don't. Now, Alberta, we see home prices, and I know like we're completely different provinces with different resources and, you know, different buyers, but like it works pretty well there. If we just removed that completely in BC, do you think it would still work? And I mean, it does work on the commercial side. There is no rent control. So
yeah,
as a lender, like if you're looking at a multifamily building, is it not just way more risky in BC because you know that you're handcuffed by rent increase?
Yeah, I would say I'm not quite as familiar on the multifamily where cap rates are right now. I'm a little bit out of touch on that. But what I would say is from a risk perspective, you know, on the residential side, we find a little bit more comfort in the rental market. Whereas on commercial, maybe you feel the ebbs and flows a little bit harder. I mean, in Kelowna specifically, vacancy on the residential side has been so low for so long. So I think that de-risks the property in a sense. Whereas, you know, if you've got commercial property and there's like one or two tenants, if one of those tenants leave, that's a big deal. Mm-hmm. So that can carry a little bit more risk. Whereas if you're in a multifamily, your risk is a little bit more dispersed because there's so many tenants in the building.
Yeah. Yeah. And I think you see that a lot of times on the cap rate too. Like people are more comfortable. Like in Vancouver, taking a 3 cap on a multifamily is great. You're not making any money, but there's a lot of security in the vacancy being 0.
Yeah, big time.
I was wondering that when you were talking about loaning, like how it feels like Vancouver's been in that space for a long time, like 10 years.
In like what, the 3.5 cap?
Yeah, like the low rental rates for how much a building costs.
Yeah, I mean, you see it also not just on the multifamily, but in the industrial commercial side as well. It's insane. Like I think I was looking at one in North Vancouver and it was 3.5, 4 cap on an industrial property. And so it's just the amount of equity to get those deals done. I guess it's been that way for a really long time, whereas we're catching up. Yeah, it is kind of mind-boggling.
So is it different lending practices here or there, or are they just coming up with more down payment?
Yeah, pretty much more money in.
I think for that, it's more institutional buyers as well, right? Like you're looking at people that are looking to park their money knowing it's like, I don't want to say it's like stress-free, but they're like, hey, I've got $50 million, whether it's from a pension fund that they're facilitating or something.
Cash stack.
Well, yeah. And they're just like, I need to park it here. I'm going to earn a small percentage, but there's going to be great capital appreciation. There's very minimal risk, where if you're trying to build up your portfolio as a smaller investor, you're going to go to like Northern BC, Northern Creston. Yeah, that's exactly what I said. Yeah. I mean, geez, Will wouldn't even lend in one time. Will wouldn't even lend in Creston. Come on, man. Yeah.
I tried.
I had to take that to your competitor.
It makes total sense, you know, like how do you get into something like that?
A lot of money. Yeah. It begs the question, like, why would you park your money there if you can make better return elsewhere? Like, yeah, there's a little bit more risk to it, but it's the same as a bank, I guess. Like banks could go out and deploy money at 12%, but do they want the headache of defaults and chasing that asset back down?
I think what I've seen is like, unless you're institutional investor, like you mentioned, like the consolidation roll-up play, whereas you've accumulated a portfolio, you leverage them up, buy one, pay that down, and then just keep rolling it up to get bigger and bigger. So, I mean, that's the only scenario that I've seen where people can pull that off, because it's hard to understand that return on investment when you're having to put so much equity in. But if you've done it for so long and you're so familiar with the space, you understand what the upside is, whether it's rental appreciation and capital appreciation. If the assets are paying for themselves, then maybe that's how you wrap your head around it.
Yeah. Well, and I guess the passive income part too is a key point, because that's taxed higher. It's 52.2% or whatever. So you'd rather run the appreciation up, which you would do in Vancouver, do a refi where there's no taxable event, deploy it on another asset where like you don't really need the income because you're going to be taxed at it.
Yeah.
You know, at such a higher rate. In terms of Kelowna then, like you're transitioning more into the commercial real estate agent role. So you're going to be out working with similar clients, and you add like a nice value add piece by being able to run the numbers and underwrite it. What do you like in the Kelowna scene right now? Like if you're transitioning into that, what's kind of the best bang for your buck that you see? Take off the banker hat, because I know you're just going to like be ultra conservative, but if you had a few $1,000,000 to deploy on some commercial real estate, where are you pointing your clients?
Well, I mean, I think this is probably the popular consensus, but industrial is very hot right now. And I think like there's such limited supply available. So we're seeing people maybe expand geographically, but if you can pick up some good industrial real estate in Kelowna proper, like you're, I think, going to do very well over the long term. Real estate development as well, like population growth is such a huge driver to this economy. And I think the secret's out, like so many people are moving here and not leaving. So I think that will continue to be really a prevalent force in how much building we see. So I think land that you can develop, there's going to be a ton of upside in the long term. I mean, driving around now, you obviously see how many cranes are about and how many multifamily properties are being constructed. So it begs the question, like, are we potentially overbuilding? Who knows? Over the long term, I think there's going to certainly be incredible demand for people wanting to move here.
Yeah. I mean, question to both you guys. Are they building a lot of industrial? I haven't really seen much, like maybe 5 years ago.
Up by the airport?
Yeah, by the airport would be the big ticket item. But once that's done, I mean, maybe Kelowna Springs, the golf course, who knows what'll happen there. But
well, I'm just, like you mentioned, there's thousands of residential units coming on, like condos. I know like there's a shortage, but that seems like it'll be saturated. And most of those people need the industrial space. I just don't know if the industrial space will really keep up to it. Like lease rates are pretty high for industrial.
Yeah, they've been on fire. But again, I just like don't understand where the supply could come from to really like curtail that. So,
well, I'm almost done my garage, so I'm happy to lease that out at $50 a square foot.
I like it.
Yeah,
I think I might have a couple takers for it.
Yeah, perfect. Let's do it. We'll kind of segue into our wrap-up questions, which, I mean, the first question is essentially what we were just talking about. But if you could buy one property in the Okanagan in the next 12 months, what would it be?
Yeah, I think, if you look at smaller markets like a Creston, you can drive significantly higher cap rates. So there was a period of time that I was looking potentially at some other investment properties in the smaller, like 1 or 2 bedroom condos. Maybe it's a couple years old. I think you can wrap your head around some okay cash flow. Like with the market where it's at right now, I don't know if you're finding a whole lot of opportunities where it is cash flowing with 20% in. So anywhere close to that, I think the longer term would look pretty good. And if you can have it almost paying for itself, I think you're doing well.
Yeah.
What's the best thing you've ever spent money on, big or small?
Well, I had a stint where I was working for the bank in Prince George. And while I was there, I bought a fourplex with a friend of mine who was also in banking. And at the time, I think we were getting like $800 a door. And the numbers still made so much sense, which was kind of great. I was like, what, are we missing something here? This is our first ever kind of bigger purchase. And then we bought it. And everything that could have gone wrong in the first 6 months went wrong. It was an absolute nightmare. One of the tenants just like, oh, yeah. I still have nightmares about it. But anyways, since then, rents are probably up like 70%. And the rental market in Prince George has really gotten quite strong. So if I could buy that thing 5 times over, even with the first 6 months I had to go through, I would do it.
So I love that you said that, because we've talked about this a bunch in the show, is that even if you buy the worst possible time, if you look back in 5 years or however long, you almost never regret it.
Totally.
Right? So like, yeah, I think with everything going on right now, we're in a perfect time.
That's why Matt doesn't ask for a Google review for 5 years. Clients over the last 2 years have been so pissed off with them. Just wait. I promise. In 5 years, it'll be a 5-star.
Yeah.
Yeah, it is true though. Like, I mean, you can get a bit emotional, but like most of those problems you forget about,
Yeah, I find that equation, I mean, I can't remember how you managed your Creston one, but it's like how that consumes your time and whether you're willing to pay someone for that, because there can be a lot of headaches that go along with running a multifamily. Some tenants are a lot better than others, and kind of how you fill up your cup with like what you're going to allocate your time to is a really important question to ask yourself when you're getting into those things.
I think like setting the expectation is very important too, because a lot of people, over the last 10, 20 years or something, it's been, hey, passive income, real estate, you buy and hold. It's really simple, but really you are buying a job. Even if you outsource it to managers and contractors, like you still have to be involved. But if you calculate the hourly rate, it's still worth it.
Yeah, very much so.
Okay, what is your favorite charity and how do you give back?
Yeah, so I've always been very involved in sports throughout my life. It's really opened a lot of doors from relationship perspective and character traits that I've picked up. And so the Special Olympics and motion ball are something that I'm pretty passionate about, to see the impact that sports can have on the Special Olympians. I've got a good friend whose son has autism, and just seeing how skiing has changed his life and the doors that it opens and the development that he has gone through from being involved in that, it's something I'm passionate about.
Yeah, that's awesome.
Love it. How can Taylor or I or a listener help you?
Yeah, well, making the leap of faith, getting out of commercial banking, getting into commercial real estate. So partnering with a great brokerage here in town, HM Commercial, and I think their values align really well with mine. There's a ton I don't know about real estate, so it's going to be a big learning curve for me, but really the mentorship that those guys can provide. I'm going to really be looking to build out my network over the next year or so.
Yeah.
So any sale, leasing opportunities, primarily going to be focusing on industrial and real estate development. And if you've got any questions on how to finance things, always happy to field those calls, really hoping to leverage my background in commercial banking into my real estate practice. So yeah, just hoping to get out in the market as much as I can.
I love that. Yeah.
Me too.
I mean, there's a lot of power to have an agent that knows how to finance those kind of properties. So sweet. Yeah, we'll pass on all our listeners your way. You better get ready, man. That phone's going to ring.
All right. Well, thank you guys so much for having me today. It was awesome to be part of the show.
Yeah.
Yeah. Appreciate it.